Hi, and welcome back to this month's Pension Finance Update. I'm John Lowell, and with me, as usual, is my partner, Brian Donahue. Glad you could join us today. So, Brian, as we look back at the month of April, as I look at things, was not as volatile a month as we've seen certainly in most of the last 6 or 8, um, dating back to the beginning of this year and late last year. Did you see the same thing?
Yeah, I think that's right. Certainly for pension sponsors, the net effect of April was not a whole lot, kind of a mixed bag. Under the hood, you did see the stocks lost some ground last month, about 3 or 4% on average. They're still up a little bit for the year, but sponsors were helped by higher interest rates. We saw rates jump, about 40 basis points in April. Up to in the range of 5.5%. And so while stocks are losing money and assets are coming down and bonds coming down at the same time with higher interest rates, on the liability side, sponsors are seeing liabilities lower. So when you net it all out, it looks like it's a little bit positive for our traditional 60/40 plan and a little bit of a negative month for our largely hedged plan, but not much overall.
So that's great. And again, one of the things you just brought up, Brian, is the fact that bonds have performed not as well with these rising interest rates, but at the same time, liabilities, as we know, have decreased because that's what does happen with pension liabilities. As the interest rates increase, liabilities decrease. But we've seen this for a whole lot longer than we had expected. The Fed kept telling us we're going to cut rates, we're going to cut rates, we're going to cut rates. And the Fed didn't cut rates. And while there's not a direct correlation between those rates and the rates we typically use when we think about pension funding or pension accounting, they certainly have an effect. What's your reaction to that? Have these rates have they stayed higher for longer than anybody anticipated?
Yeah, I don't think there's any question about that. The Fed is in a bit of a they're between a rock and a hard place a little bit, right? If the economy holds up and inflation comes down, the Fed's got room to cut. But if inflation kicks up like we saw last month, that creates a stir in the markets and interest rates are going to shoot higher. People that are lending money are really sensitive to inflation, and if they think inflation is going to be higher, they're going to demand higher yields. In that environment, the Fed is limited in its ability to cut rates. So yes, they wanted to cut rates for most of this year, but the prevailing economic conditions, particularly the persistent inflation, has really checked the Fed and its ability to cut short-term rates. So I think this in part is part of the explanation for higher longer, that expression that we use to describe what's going on with interest rates. Rates are back up at 5.5% now. We're talking about long-term rates generally, and those are the rates relevant for pension sponsors for liability measurement. Higher rates mean lower liabilities. So that's good news, and that helps sponsors sustain the impact of lower stock prices. But these higher rates are also are putting an end to funding relief. Plans have, I think we've mentioned this before, the plans have enjoyed ability to write down their liabilities for funding purposes for the past several years. That's over in 2024, and it might actually go the other way in 2025. This means that minimum contributions are likely going to be going up for plans. We're seeing that already in 2024. Plans that didn't have to put money in for years are facing cash requirements now for the first time in years.
I've been having some interesting conversations with clients, and the same sort of things are coming up. And Brian, you and I have talked about this, how many pension sponsors recently have been funding well in excess of the minimum required contributions, oftentimes to meet certain financial metrics under whatever, accounting standards are really important to them, or to completely eliminate PBGC variable rate premiums. But when that became a really big thing, well, certainly one of the years when virtually everybody who could possibly do it was doing it was 2021, when people were paying nothing to borrow. Interest rates were so close to zero for people with really good credit. that the cost of doing it was that low. But what clients are saying now, they're saying my cost of borrowing is higher. But not only that, my credit's tighter. And I need to use my available credit to run my business properly. So that combination is really causing a lot of companies who have not been minimum funders to say, you know what? I'm not going to worry about my pension funding as much this year. I might go back to being a minimum funder for a while. I might use that credit balance in lieu of throwing cash in the plan. So there's a lot of that going on. The one other thing that this reminds me of, and this goes back and it kind of ties what I just said, I think, back to what you said in the last segment, but I'm old enough to remember the late 70s. And while the chairman of the Fed, Jerome Powell, has said, no, this is not happening, this really is reminiscent of the days of stagflation, a stagnant economy with inflation increasing, and that creates just massive problems for businesses and presumably for their ability to fund. Any closing thoughts on that?
I'm seeing a lot of the same thing. Tighter credit conditions, opportunity cost for cash is a lot higher now. So as funding really fades and funding requirements are going to go up, companies' ability to meet those funding needs because of tight credit conditions is going to be tougher. So this is a bit of a rock and a hard place. On the stagflation score, I'm pretty old myself. I remember the 70s. I think nobody really knows for sure. Just this morning, we got unemployment numbers that don't look great. We've had inflation in the last month that wasn't great. I mean, that's the definition of stagflation right there. So just 1 month. I don't think we can call it yet, but we can't rule it out. And like you say, it's going to create lots of problems for consumers, lots of problems for businesses. Curiously, pension sponsors, especially for frozen plans, are one constituency that might not suffer so much because if interest rates do continue to go higher, then your promises are going to be easier to finance. But if that's because inflation is higher, that means that the retirement income the participant's getting isn't going to go as far.
Well, those are great insights, Brian. Thanks for wrapping it up and pulling everything together. We'll continue to monitor all these things that we're talking about this month, and we hope to see you back again next month.